Uh, Good evening, everyone. Uh, Today we're going to be looking at quiz number one for Fin4801. So you see that when it comes to the questions for quiz number one, the sequencing of the questions might be different, but take note that even though the sequencing might be different, the questions are the same, right? So the first question to someone else might be question number 9 to someone else as well, question number 8 to someone else as well. So please take note of that. So looking at this from the sequence of the questions that I have, when it comes to the first question that I have is the question which looks at this company. All right, so looking at this question, they say a public company, Well Limited, which sells water tanks, was established 20 years ago. The original founding family listed the company 10 years ago, but remained significant, but not controlling shareholders. Around the same time the company was listed, the founding family relinquished their management roles and gave over to a new management team, which has not changed substantially over the past decade. So recently, the current management indicated that they wish to double the company's debt ratio and are planning a rights issue to fund the acquisition of a game farm and a hotel, which the current CEO is selling from his family trust. So indicate by choosing the most correct answer below of which relationship is the above information an example, right? So where the relationship that is being highlighted in this case is where we're seeing that the current CEO is pushing for there to be an acquisition of a game farm and a hotel, which is basically being sold by his family trust, right? So which means we're looking at the conflict of interest. Basically looking at the conflict of interest between the principal, which is basically the shareholders, and also the agent, which is going to be the CEO in this case. So which means the relationship that is being highlighted in this case is an agency relationship, where the principal is the shareholders and the agent is the CEO. So your answer is going to be indicating the agency relationship. Any questions? Any questions? All right, so moving on to the next question. On the next question, they say, in terms of market efficiency, how would you classify a stock exchange where the following happens? Books Limited, a highly liquid, traded, large and widely followed by analyst company, trades on the shelf exchange 2 days ago at 1700. After closing of the markets, its shares traded at $15 a piece. At the same time, the company issued a statement and sent out a press release indicating that the company expects to make a somewhat unexpected loss in the current financial year. And yesterday, the share price remained at $15, and today it is still $15. So there were no other major macroeconomic, market-related, or company-specific developments that would have affected the company, and the market was mostly flat over the day. So even when they made an announcement, right, there was no movement in the share price. Reason being, the investors would have already accounted for potential movements not in share price as well. So which means that with the adjustment in the share price would have happened prior, which means that the investors would basically have anticipated such a movement as well, such a change. So because of that, we would say the market is what? Perfectly efficient, because it means that the information was already accounted for. Are we on the same page? Any questions? Anyone lost? On the next question, they give us that information about that company, and then they say, determine the value of the investment alternative and choose the most correct option below. So the first option is to invest this money in a new in the investment alternative where they are considering investing in a new software. And the other alternative is where they look at putting this money in a money market account. So we need to check to see exactly, so what would be the better alternative? So if you look at the investing in the new software, we see that if they invest 2 million today, after 3 years, they'll end up with 2.5 million. But if they invest in the money market account, if they invest 2 million today, they are going to be earning 15% per year. So now the question is, how much are they going to end up with if they invest this money in a money market account? So which means we already know exactly how much they end up with if they invest in a new software for the new project. But what we don't know is exactly how much they end up with if they invest in what? In the money market account. So to see how much they end up with if they invest in the money market account, we're going to say from the given information, the money that they're going to invest today, if they invest in the money market account, so if they invest in the money market account, the present value is the money that they're going to invest today, which is 2 million. The interest rate is 15% per annum, and the number of periods in this case is going to be equal to 3. So the money that they're going to end up having in 3 years' time, it means we are looking for the future value. Now, for us to get to this answer, it takes us to the chapter where we look at time value of money, right? So it's basically a time value of money assessment type of question. Now, when you look at time value of money principles, remember we said you can either use the sharp calculator or you can use the HP calculator, right? So you see that in the classes that on the videos going to the classes as well, the demonstrations there are either using the sharp calculator or using the HP calculator, right? Now, when it comes to this calculation, you see that we need to remember the principles of using a financial calculator, right? And the first rule of using the financial calculator, is always clear memory unless data entered is still relevant. So unless the data that you've entered is still, that has been entered previously, is still relevant, always make sure that you clear memory. Now, how do you clear memory on your financial calculator? If you're going to be using the Sharp financial calculator, so if you're going to be using the Sharp financial calculator, you press second function, alpha 0, 0. Then it means you've cleared your memory. Then if you're using the HP calculator, you're going to press shift. And then after you press shift, you look for the button which says C on. And this means your financial calculator is now, you have now cleared the memory on your financial calculator. Now, when you're using the HP calculator, there's also something that you need to make sure that you take note of as well. When you're using the HP calculator, whenever you press shift and you press CO, it must always show you one PYR on your calculator on your screen. The moment you say shift CO, it must show you one P/YR. Reason being, the HP calculator also takes into account how many payments per year must you enter as well. If you're going to be, either the payments are going to be made once a year or twice a year, but to make our lives easier, we assume one payment per year. So if it's not showing you one payment per year, how you can make it to one payment per year on your HP calculator is that you're going to say, you press 1, and then you press shift. Then you press P/YR. And the P/YR function, you find it there where you find PMT, where your PMT button is basically where you find the function P/YR. The reason why you press shift on your financial calculator is mainly because if it's the HP calculator, you're looking for the maroon or orange function on your calculator. And if it's the Sharp calculator, you're also, if you press second function, it means you're now looking for the orange or maroon function on your calculator. So that's basically how you clear your memory, and this is how you put your calculator into one payment per year, in case it's not in one payment per year. Are we on the same page?
Yeah.
So if you invest in the money market account, how much do you end up with? So if you invest 2 million in the money market account, how much do you end up with? Remember, if you're doing the calculation, if you're using your calculator, you press the value and then you press what the value represents on your calculator. So you press 2 million and on your calculator, press PV, because you're telling the calculator that 2 million is my present value. So you press 2 million and then you press PV. You press 15, you press interest per year button, because you're telling your calculator that this is the interest. Then you press 3 and you press N, because you're telling your calculator that this is the number of periods. Then for those who are using the HP calculator, you just go ahead and press FV directly. But for those who are using the Sharp calculator, you always have to press comp, then FV. So for those who are using the Sharp calculator, you need to tell your calculator that you're computing something. So you're always going to say comp FV, then you look for the future value. And if you look for the future value, how much do you get as your future value?
Okay, I stand to be corrected. It's 3,041,000. 3041 750.
04
750.
750.
Yeah.
750.
Well, I stand to be corrected. Yeah.
That's your answer. So that's the correct answer. So if you invest in the money market account, you end up with this, isn't it? Are we on the same page? Any questions? Anyone lost on how we are arriving at this figure? Now, so what are we better off investing in? If we invest in the money market account, we end up with this figure. But if you invest in the computer software, remember we were told that we get 2.5 million after 3 years. So what does that mean? It means we're better off investing in the money market account, isn't it? Because we end up with what? More money. So which means your conclusion on this question would be they determine the value of the investment alternative. So the investment alternative is that we're going to end up with 3,041,750, and it would be better to invest the profits. So we're better off investing the profits, because if you invest the profits there, we end up with more money compared to putting this money in a what? In a investment where we put it in a new project.
Yeah, software.
Any questions? Anyone lost? Next question. They give us that information. So they say, would it be worthwhile for the company to go for the automation process or retain the current practice? So if we go the automation process, we are told that it's going to cost us. Remember, they say the business way to work, where you work, and a sales pitch from a company automating some document handling process at a cost of 500,000 per year for the next 5 years. So it is estimated that doing so will save the company 2 million in today's term. So in today's term, our benefits are totaling 2 million. But the cost of doing so is going to be 500,000 per year for the next 5 years. So which means, so the question is, remember, a good economic decision is one where your costs are less than your benefit, isn't it? As long as your benefits are more than your cost, it means you're making what? A good economic decision. So if this is the present value of our benefits, now we need to find out exactly what is the present value of our costs, because these costs are going to be, we're going to be incurring 500,000 for the next 5 years, and then they tell us that the discount rate in this case is going to be 15%. So which means to find the present value of our costs, we're going to say so the value of our costs in today's terms, right? What are we told? The cost of 500 per year for the next 5 years. So this 500,000 is not going to be incurred once off, isn't it? So this cost of 500,000 is not going to be incurred once off. We're going to be incurring this cost on an annual basis for the next 5 years. So whenever you're seeing a cash flow that is recurring, remember we're dealing with time value of money. It's basically a time value of money chapter question. So whenever you're dealing with a cash flow that is recurring, it means you're dealing with a what? An annuity. And an annuity on your financial calculator is the function PMT. So whenever you're faced with an annuity on your financial calculator, it means the function that you're going to be dealing with there is going to be your PMT function. So which means in this case, if our PMT is equal to 500,000, our interest is equal to 15%. And if our number of periods is equals to 5 years, then the value of the cost in today's terms means we're looking for the present value. So on your financial calculator, remember we said always clear your memory unless the data entered is relevant. the data we have entered previously here is no longer relevant, which means in our new calculation, so which means we need to clear our memory, isn't it? So you need to follow these steps to clear your memory. Then after clearing your memory, then you enter the new data, and then you look for present value. So if you enter the new data and you look for the present value, what is going to be the present value of these costs?
$167,607.55.
167,607.55.
77. Yes.
Which is closest to 0.78,
Yes.
when you round it off to the nearest range.
Yes.
So what do we see? The present value of our benefits is equal to 2 million, and the present value of our cost is equal to 1676078. So is it going to be worthwhile for us to invest in this? So would it be worthwhile for us to invest in this? Remember we said
because we're making it a loss.
it's a gain. Remember,
No, so it's a gain because the costs are lesser. Yes.
Yes. So as long as our benefits are more than our costs, it
Our
means we're
costs,
making
yes.
a good economic decision.
Again,
This is very much based on the principle of the net present value. If you now go on with the chapter where we look at the capital budgeting, where we say your net present value is given as the present value of expected future cash inflows minus initial investment. And we say when your net present value is greater than 0, it means you should accept the investment. And if your net present value is less than 0, it means you should change. This goes back to the same principle, because we're basically saying our expected future cash flows are the benefits, and our initial investment is basically the cost. Which means as long as our benefits are more than the cost, the difference there is going to be a positive value, hence we accept. So it's basically based on the same principle as well. So which means looking at this question, your answer would be, so we see that the present value of our cost is going to be equal to 1,676,078. So it would be worthwhile for us to invest. So it would be worthwhile for us to invest because our benefit, the present value of our benefits is more than the present value of our costs. Any questions? Anyone lost? So we can move on to the next question. On the next question, they give us that information. So they're telling us that you would retire in 20 years' time, and you're expecting to receive 5 million when you retire in 20 years' time. But to supplement this amount, you are going to be contributing an additional 36,000 per year into your savings account, and it's going to be earning 6.25% per year. So how much is going to be available for you for your retirement in total? So which means this 36,000 per year is going to be earning 6.25%, and it's going to be over a period of what? 20 years. But remember, they say if you paid 36,000 per year, so if you paid 36,000 per year, it means this 36,000 is a recurring amount. If they had just said if you paid 36,000 and they kept quiet, right, then we're going to say it's a present value lump sum amount, right? But they said if you paid 36,000 per year, which means there is some form of recurrence that is going to be happening in this case. So because this amount is recurring, it means we're dealing with what? An annuity. And remember we said an annuity on your calculator is going to be the PMT. So we need to find out exactly how much is this 36,000 going to be worth after 20 years. So we need to find out how much is this 36,000 going to be worth after 20 years. So for this question, we're going to say our PMT is 36,000. Our number of periods is 20, and the interest is 6.25. So given this information, we are looking for the value of this money in 20 years' time, right? So if you're going to be looking for the value of this money in 20 years' time, it means we're looking for the future value. So in this case, we are looking for the future value. So given this information, how much would you get as the future value?
1360.
1360.
428.
428 to the nearest range. So 1360, 428. So which means the total retirement amount is going to be equal to the future value of this 1360, 428 plus. Remember they say you're also going to be having that 5 million that you're going to receive as well. So how much is going to be the total of the retirement amount?
6360
6360.
428.
So that's the total amount that you're going to end up having in the retirement. Any questions? Anyone lost? Okay. So on this question, your answer will be the amount of 6,360,428. Moving on to the next question. So they ask us to find the standard deviation of the following distribution of possible cash flows. So they give us the cash flows, and then they give us the probability of earning those cash flows. So to find the standard deviation, we're going to say, to calculate the standard deviation, step number one, we need to determine the expected cash flow. And this can also be written as ECF. It means determining the expected cash flow. or this can also be written as cash flow with a bar on top. So that's basically the notation that you can also use to indicate you're determining the expected cash flow. And the expected cash flow is given as the sum of the individual cash flows multiplied by the probability of those cash flows. So it's given as the sum of the individual cash flows multiplied by the probability of earning those cash flows. So that's how we determine the expected cash flow. Step number 2, we need to determine the variance. And the variance can also be represented by this sign. And this means that your variance is given as the sum of the cash flow minus the expected cash flow you have determined above. You square that and you multiply that by the probability. So this is what you're going to do for every scenario that you're going to be dealing with. Then after you determine the variance, step number 3, which is the last step, that's when you determine the standard deviation. And the standard deviation is represented by this. And the standard deviation is simply the square root of the amount that you get as the variance. Are we on the same page? Any questions? Anyone lost? So you find this under the chapter risk and return, and it's also under the chapter where you look at portfolio management. So you find this under the chapter on risk and return, and you also find this under the chapter where you look at what? Portfolio management. So to find the expected cash flow in this case, we're going to say for the first scenario, your cash flow was 1,000 multiplied by the probability of earning that cash flow is 0.1. And remember, all your probabilities, when you add them up together, they should give you 1. If they don't give you 1, it means that there's something wrong with that list of probabilities. Now, remember we said we're summing up, isn't it? So after this scenario, for the next scenario, we're told that the cash flow is 2,000, and the probability of that cash flow is 0.2, plus, because we're summing up. The next one, the cash flow is 3,000. And the probability of earning that cash flow is 0.5. Plus, the cash flow is 4,000. And the probability of earning that cash flow is 0.1. Plus, the cash flow is 5,000. And the probability of earning that cash flow is 0.1. So given this information, how much would you get as the expected cash flow? How much do you get as the expected cash flow? So for
Stand
the
to be
first one,
corrected. 2450.
okay. For the first one, you must be able to get a figure of 100.
100 rand.
And the next one, you must be able to get a figure of 400.
100.
And the next one is 1.5.
Mm.
The next one is 400.
400
And the
and
last one
500.
is 500. So it will be how much?
2900.
Yeah,
No.
because 2,800, 900. So your expected cash flow in this case will be 2,900. Are we on the same page? Any questions? Anyone lost? Now we need to determine the variance, isn't it? Remember we said now for the variance, for the first scenario, we saw that the observed cash flow was 1,000 minus the expected cash flow of 2,900 squared multiplied by the probability of earning that cash flow, 0.1. Next, the observed cash flow is 2,000 minus the expected cash flow of 2,900 squared multiplied by the probability 0.2 plus next observed cash flow is 3,000 minus 2,900 the expected cash flow squared multiplied by the probability of 0.5. 4,000 minus 2,900 squared multiplied by the probability of 0.1 plus 5,000 minus expected cash flow of 2,900 squared multiplied by the probability of 0.1. So given this information, how much would you get as the variance? So how much would you get as the variance if you do the calculation there? How much do you get? So if you do the calculation, for the first calculation, you must be able to get a figure of 361,000 plus second one, 162,000. 5,000. 121,000. 441,000. So if you add them up together, you get a variance of 1090,000. So you get a variance of 1090,000. Are we on the same page? Any questions? Anyone lost?
Yeah, I am a bit lost, Rhinus. How did you get to
Mhm.
those figures? Can you just take me through that?
Which calculator are you using?
HP 10B2 plus.
Now, if you're using the HP, it means you're going to first say 500 minus 2,900. You get your answer, right?
Sorry, 5,000.
Yeah, 5,000 minus 2,900. Then you get your answer.
Yeah.
Then you need to put it to the power of 2 is in that answer. So if you press shift, you see where the plus sign is, right? Right at the bottom
Yeah.
right corner.
Yeah. Yeah.
So that answer you say shift, then you press
Mhm.
x squared means you're putting the answer to the power of 2. Then you say equals to. Then
Sorry,
if you
shift
say
and then?
x, there's this button which says with an x and a 2 on top.
Yes.
You press that button, it gives you an amount, isn't it?
Yes.
Then you multiply that amount by 0.1. If I did the calculation for the last one, are you getting a figure of 441?
No. I think I'm going wrong somewhere there.
So if you say 5,000, okay,
Yes.
if you say 1,000, let's start with the first one. 1,000
Mm-hmm.
minus 2,900.
Yes.
Are you getting the answer?
Yeah, it's minus 1.9.
Then you say shift,
Yeah, the
and then you
X
press
X.
this function. Are you getting the answer?
Okay, just a second. Hold on. Mm.
Are you coming right?
Yeah, got it. Thanks.
Okay, so you do the same. If you're using the HP calculator, rather do this calculation, get the answer, do that one, get the answer, then the final answer, then finally you add them up together. Those who are using
Okay.
the sharp calculator or the scientific calculator, right? What you do is you open brackets, then you say 1,000 minus 2,900, you close brackets. After you close brackets, you press this button with your Y with an X on top. Then the moment you press Y with an X on top, you're basically saying Y is this that is in the bracket, X, you're not trying to put it to the power of 2. So after this, you press 2, then you say multiplied by 0.1. You'll see that you get the answer directly like that. Then whatever answer you get, you go move on to the next one, then you move on to the next one until you get to the last. Are we on the same page? Any questions? Anyone lost? Now remember we said we're looking for the standard deviation, right? So the standard deviation is going to be the square root of the variance amount that we got of 1090,000, and how much you get as the standard deviation. How much do you get?
1044.
1044.
Yes.
Are we getting the same amount? So in this case, your answer will be 1044. So that will be your standard All right. We have an unscheduled power cut in our area. I don't know what's happening, but we can continue. So remember, in our calculation, we're calculating the standard deviation, and we got a figure of 1044 as the standard deviation. So if you check on the questions, your option would be the figure of 1044 being the standard deviation. Are there any questions on before we move on to the next question? Any questions? Right. On the next question, they say a project is an expected return of 50 Rand with an associated standard deviation of 10 Rand. What is the coefficient of variation of the project? So we're looking for the coefficient of variation of the project. So if ever you're asked to find the coefficient of variation of the project, please take note that to determine the coefficient of variation, this is a separate question. To determine the coefficient of variation, your coefficient of variation is given as the standard deviation divided by the expected value. So it's your standard deviation divided by your expected value, or in this case, it's going to be expected cash flow. So your standard deviation divided by your expected cash flow would be your coefficient of variation. So in a different question, if they had asked you to say, calculate the coefficient of variation, you should know step number 1, you calculate the expected value. Step number 2, you calculate the variance. Step number 3, you calculate the standard deviation. Then step 4, that's when you'll be calculating the coefficient of variation. So you don't calculate the coefficient of variation before you get to the standard deviation. But in this case, since they already give us the standard deviation and they already give us the expected value, we can calculate what? The coefficient of variation. So in this case, your coefficient of variation is going to be equal to, they tell us that they give us that the standard deviation is equal to an amount of 10 Rand, and your expected value is equal to an amount of 50 Rand. So which means your coefficient of variation in this case is going to be equal to your standard deviation of 10 Rand divided by your coefficient of variation, divided by your expected value of 50. So this will give us the coefficient of variation. And how much do you get as the coefficient of variation? How much do you get as the coefficient of variation? If you do the calculation, how much do you get as the coefficient of variation?
.20.
Yes, so you get a coefficient of variation of 0.20. So your coefficient of variation in this case would be equal to 0.20. So if you check on your options, your answer there is going to be a coefficient of variation of 0.20. Can we move on to the next question?
So Rhinus, just to take it back a bit. So what were we calculating here?
Coefficient of variation.
Okay.
Yeah. So we're calculating the coefficient of variation. And remember, we said your coefficient of variation is given as your standard deviation divided by the expected cash flow. So we're given the standard deviation and we're given the expected amount as well. So the standard deviation divided by the expected amount will give you your coefficient of variation. I also said, sometimes if they don't give you that information already, it means you can also start by, to get the coefficient of variation, you can also start by determining the expected cash flow, then the variance, and then the standard deviation. So using the standard deviation and the expected cash flow, you can also be able to determine now what? The coefficient of variation. In case they make it a longer question as well to get to the coefficient of variation. Please note, as the typical question in the exam, typically in the exam, this is not how they bring the question in the exam. How they would bring such a question in the exam is that you are going to be using it, this question if it comes as a short question, yes, they can bring it like this. But in some cases, they can also bring it as a part of a case study type of question. Like where they say, for example, if a project is a question of variation of so much, you now need to add a certain amount as a risk premium, where you're now adjusting your discount rate based on the risk amount that you're having, which is basically what you are now going to be looking at now. When remember we said chapter 8, you are looking at the introduction to capital budgeting. Then chapter 9 and chapter 10, you are going further on in further understanding what capital budgeting is. Can you move on?
Yes, thank you.
Yes,
right.
thank you.
On the next question, they give us that information and they say, a company prefers projects with less risk per unit of return. If two projects are considering, it is considering a coefficient of variation of respectively 1 and 3, which of the two projects would the company prefer and why would it prefer it? Choose the most correct answer. They say the company prefers projects with less risk per unit of return. If you go to the coefficient of variation, remember we said your coefficient of variation is your standard deviation divided by the expected amount or the expected cash flow. So what does that mean? As interpretation of the coefficient of variation, we're basically saying how much risk are you exposing yourself to in pursuit of an expected return? So how much risk are you exposing yourself to in pursuit of an expected return? So ideally, in investment, we say you want to maximize your return for a given level of risk. And at the same time, you want to be able to minimize your risk for a given level of return. So which means in this case, for a given level of expected return that you're pursuing, your aim is to minimize your risk as much as possible. So which means the project that you're going to be choosing there is the project with the lower coefficient of variation. So if you check on the question, your answer in this case, if you're going to be comparing a project with a coefficient of variation of 1 and 3, it means your answer would be the project with the coefficient of variation of 1 is it carries less risk per unit of what? Of return. So that will be your answer. Are we together? Any questions? Anyone lost? Next question. So the company has a beta of 1.5, and if the JSE or share index moves up by 10%, how much would you expect the company's computer company limited share price to move as well, right? So when you look at the beta, beta basically measures gradient, where you look at the change in Y over the change in. So basically, when you look at measurement of a gradient from it, we say your gradient is equal to your change in Y over your change in X. And in this case, When you're now looking at it from a market perspective, basically saying the change in Y is your change in your asset return, and your change in X is your change in the market return. So the beta is given as your change in the asset return divided by the change in the market return. So if they tell us that the beta of this asset is equals to 1.5, by default, the beta of the market is always equal to 1. So by default, the beta of the market is equal to 1. Because remember, when you look at it, if you're given a value of 1.5, this is the same as saying 1.5 over 1. If you're given a value of 6, this is the same as saying 6 over 1. So we always ignore that divided by 1, because remember, any number divided by 1 is that number. So by default, the beta of the market is equals to 1. So which means in this case, we're saying if the asset has a beta of 1.5, the beta of the market is equals to 1. So what it means is that if the asset changes by 1.5 units, the market will also change by 1. So which means when the market changes by 1 unit, the asset will change by 1.5 units. So if the market changes by 1 unit, the asset will change by 1.5 units. Now, since the beta is a positive value, so since the beta is the positive value here, it means the asset and the market, they are moving in the same direction. So when one increases, other one increases. So since the beta in this case is the positive value, it means the asset and the market are moving in the same direction. When one increases, the other one increases. So it means in this case, when the market increases by 1 unit, the asset is also going to increase by 1.5 units. So which means if you check now on the information that were given on the question, so if you check on the information that they give us on the question, they tell us that the asset has a beta of 1.5. So if the JSE All-Share Index moves by 10%, what do we know? If the All-Share Index, which is the market, moves by 10%, Computer Limited is going to move by what? 1.5% of that amount. So it's going to move by 1.5 times that amount. So if the market moves by 10%, goes up by 10%, Computer Limited is going to also go up by 1.5 times that amount. So which means in this case, the beta of Computer Limited, the change in share price of Market Limited is going to be equal to, it's going to be Computer Limited. So the change in share price, the change in Computer Limited share price is going to be equal to, the market is going up by 10%. For Computer Limited, it's going to be increasing by 1.5 times that amount. So how much is going to be the change in share price in Computer Limited? How much is that going to be?
15%.
So it's going to go up by 15%. So it's going to increase by 15%. In this case, Computer Limited is going to increase by 15%. Are we on the same page? Any questions? Anyone lost? So can you move on to the next question? All right. So for this question, your answer will be an increment of 15%. On the next question, they give us that information. So they tell us that the bond is currently selling at a market price of 10,000. It will mature in 10 years' time. There's a coupon rate of 10%, and the par value is equals to 10,000. And then they ask us for the yield to maturity. So if you're calculating the yield to maturity in this case, this is where you look at bond valuation. So this is basically under the chapter where you look at what? Valuation. So when you look at the chapter on valuation, you look at valuation of debt, and you also look at the valuation of what? Of equity. And the most common type of debt that you look at valuation on is going to be bonds. So when you're looking at the yield to maturity in this case, the yield to maturity in this case is basically the interest per year on your calculator. So what do we see? We're basically saying the current price of the current price, the bond is currently sitting in the market for 10,000. So that's the market value of the bond, isn't it? So I'm basically saying if you invest 10,000 in a bond today, you are going to be able to earn 10% income on the par value of 10,000 that you're going to get back after 10 years, in 10 years' time. So given this information, the yield to maturity is the interest per year. So which means your yield to maturity in this case, how you get to your yield to maturity, you are going to say the present value of the bond is your PV. So your present value is equals to 10,000. But please take note, you need to acknowledge the movements in cash flows. We're saying if you invest in a bond today, you're losing money. Then after you lose money, you're going to get back your money through coupon payments, which is a cash inflow to you. And you get back your money when the par value is repaid to you. In the case where you invest in a bond. So which means the present value of the bond, you are going to put it as what? Negative value. And to make it the value negative, you say plus minus. What else are we given? We also know that to get to the PMT on the bond, which is the annuity of the bond, is given as the coupon rate multiplied by the par value of the bond divided by the number of times you're compounding per year. So what is the coupon rate? The coupon rate in this case is 10%. So as a decimal, you're going to say 0.1 multiplied by the par value of the bond in this case is 10,000. They don't say how many times you're compounding per year, so you're assuming you're compounding once a year. So you don't need to adjust it. So this becomes your PMT. So this basically becomes your PMT that you're going to enter on your calculator. Remember, we are already told that the par value of this bond is equals to 1,000. So your future value 1,000, and you're putting it as a positive cash flow because if you invest in a bond today and spend 10,000, we're saying you get back 10,000 after 10 years. Then the number of periods is equals to 10. So given this information, the interest per year that you're going to calculate is also your yield to maturity. Then how much do you get? So how much do you get as the yield to maturity on the bond? How much do you get? How much do you get as the U to maturity?
Recording in progress.
So how much do you get as the U to maturity?
Sorry, Ines, just to on the PMT, can you just what is that in orange? Because I can't see that.
It's your coupon rate. Oh, okay. It's your coupon rate. So it's your coupon rate multiplied by the future value divided by the number of times you're compounding per year. So remember the coupon rate they give us is 10%. So we multiply, we put it in 0.1, multiply by the par value, which is the 10,000. But remember we said because you're compounding once a year, we don't need to worry about the compounding frequency because it's going to be 1.
Okay.
So given this information, how much would you get now as your how much would you get? You must be able to get a figure of 10. So you must be able to get a figure of 10, which is 10%. So you must be able to get a figure of 10, which is 10%. Are we getting the same amount?
Yes.
All right. Right. Is there another question that you came across that is not part of the questions that we have looked at so far? Is there another question that you came across which is not part of the questions that we came across so far?
I just want to confirm on this question. So the PMT would be 1,000 rand. I stand to be corrected.
1,000 rand, yes. It will be 1,000 rand.
Okay.
Remember, the present
Mm.
value, you punch in 10,000, then you press
Yes.
plus minus.
Yes.
Mm. Is there other questions from things that you've come across? That is not one of the questions that we have covered so far. All right. If you come across any other question, please take a picture and send me. And what I'll do is that I will create a memo for that, and then I'll share it as well. I'll share the answer as well. So if you come across a question that we have not covered so far, just make sure that you take a picture and you send it through to me or to the group on WhatsApp. And then what I'll do is that I'll share that question. I'll share I'll create a memo and then share that answer with you as well, with the whole group. All right, if there are no questions, enjoy your evening. Please keep revising. If you come across any question, just make sure that you share that question with me. I'll create a memo and I'll share the answer to that question as well.
Okay, thank you.
Enjoy your evening.
Thanks,
Yeah.
you too. Bye.
Bye.